You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend Mike Taylor. Mike runs the Simplify Healthcare ETF. Mike, he's like one of the smartest investors I know, 100%. You can just go through his Twitter feed. I think it's Mike_Taylor 1971, right?
72. Yeah, give me that one last year. I'm not 50 yet, buddy.
Mike, so thank you so much for being on the podcast.
Thank you so much for having me. I am so delighted to speak with you and your audience, because I don't get to speak to a terribly young audience all the time. And I'm very excited about it.
Awesome. So Mike, before we get started, I wanted to sort of dig into your background. So, how did you get into the business? How did you, how did you actually become, an investor? So I believe you started off studying biology or some aspect of science in university, right?
Yes. Your listeners, if they wanted to get into this business, I would say chase and challenge yourself in things that you love, things that you enjoy. I went to college, a small liberal arts college in Pennsylvania, and I didn't know what I wanted to do, and I was a fine arts major. I sang, I did acting and instruments and painting, and about 2 years into it, I discovered that I really loved all those things that I was doing. It's just that I felt that most of the people around me had a great interest in not doing anything in life except smoking pot. And while that's a lot of fun, I decided that maybe I should look at doing other things in college too. And that's when I discovered biology. And back in my day, people were very undecided frequently of what they would do with their life while they're at college. They had no idea. Yep. And I was one of those people where I was just, hey, I'm going to find out what I really like. You have the incredible luxury right now with the internet. Remember, the internet didn't exist when I was 17, 18, 19. Only when I was about 19, 20, that's when it started coming in. And that's when I was at college. And my college was like really fancy because it was one of the only colleges that was hardwired for what we called the internet. And that's what it was like. Anyway, so I found biology. I loved it. I really enjoyed it. And that's what I did. And so I graduated with a biology degree. I made some modest discoveries in cloning while I was there. And that got me to Johns Hopkins to do a lot of different things at Hopkins, but I ended up there for a number of years, and I was had intended on doing a PhD program, but like many things in life, I discovered that while I love the science and I was good at doing the science, at that time science was all perspiration and very little inspiration, meaning there were no machines like they are now. Everything was done by hand. So it was real alchemy in a laboratory, an incredible amount of toil. And it was kind of unfortunate because I enjoyed the science, I enjoyed the experimentation, I enjoyed the cerebral challenge, and unfortunately I was actually good at it. So what happens when you're good at it is that everybody gives you the most difficult things to do, like, for instance, working with RNA. RNA is the single strand form that's read off of DNA, and it's used to translate into protein manufacturing. And RNA will degrade in a heartbeat. And I just happen to be very meticulous at my laboratory bench, and I'd wear a shield over my face and I'd hold my breath, because you get breath on this stuff and it degrades immediately. And so I just was good at it, and I ended up getting every single nasty RNA project that there was because I could get it done. And it was awful. It was awful. I was like, oh, I'm really good at this. I hate it. And so I said, oh, well, Jesus Christ, I don't want to do a PhD in this. I want to actually go out there and start building something, making something.
Yep.
And I found myself at a small gene therapeutic company. I didn't do a PhD at Hopkins. I took a master's degree, which basically is for people who don't want to do the PhD, which could take 5 to 7 years at Hopkins. And so I left and went into science. And the funny thing is that I was like, oh, finally, now I can do it. And they find out, wait, you're really good at RNA? Oh, do we have jobs for you? And here I am. I'm just like, Anyway, I learned a lot from that, because I was perfectly equipped to do anything as long as it involved toiling at a bench and working with RNA. But I did get to wear a lot of hats when I was doing gene therapeutic research, working with viruses to deliver transgenes to serve therapeutic purposes. And I worked on 2 projects that made it into the clinic, into humans. And I was about 27 years old, and many things happened all at the same time. We got these drugs into the clinic, and at the same time, and it must have been that month or around that when we got into the clinic, and I'm in the laboratory toiling away, and there's a TV in the corner, and there's this new channel called CNN FN, the financial news channel for CNN. They had that at the time. And a guy gets on the television and he starts pitching biotech stocks. And his name was Mike King. And I looked at that and I was like, are you kidding me? That job exists? You can do that? I was like, how the hell do I get into that? And a little later, we had a celebration for getting our drugs into the clinic, and this is great. And I was not as enthusiastic as everybody there, because I didn't think that they'd function in the clinic, meaning it would fail in humans. And I remember my boss turning to me and saying, Mike, cheer up. You don't understand. He goes, what are you, 27, 28? And I'm like, yeah. He goes, people work their entire lives in the laboratory and they never get a drug into humans. This should be one of the high point of your career. And I thought about that and I was like, are you kidding me? This is it? This might not ever happen for me again. I got to get out of here. I have to, because I'm able to look at the science and say, it's not going to work in humans. I don't know what we're partying about. And so I said, okay, how do I become Mike King on television, pitching stocks? And so I said, I need to know finance. I don't know anything about finance. So I was very fortunate, and I got a fellowship at the University of Rochester, where I got an MBA. And during that time, 1 year in, I got very fortunate to get an internship at Oppenheimer Funds, and I was their healthcare guy. And even that interview process and all that was very detailed, very selective, and I was extremely fortunate. I was one of 3 people that got in. And it was an interesting situation once I got in, because I realized that their head of healthcare didn't know a lick about science. And that's when I discovered, so here I was about 29, 30 years old in business school, and I'm sitting there and I realized this person that's in charge of billions and billions and billions and billions of dollars doesn't know anything about science. And that's how most of Wall Street was at the time, because you have to recall, molecular biology is new at that time. and working with RNA, DNA, and all of these new machines that are starting to come into place to make it not just toil at the lab bench, but to accelerate everything. So one person could do a machine could do 20, 30 persons worth of work. And so now it was starting to escalate. And I didn't actually realize it at the time, but it was in a short time after that I had a very, very unique skill set on Wall Street, and I couldn't be fooled easily like some of the people that were running big healthcare money, looking at these biotech companies that didn't know anything about science. It was just too much of a leap for them to know what's good and what's not good. And so I ended up being the right person at the right time in the right place. And it was really just because I was willing to fail. I was willing to put myself on the edge and try new things without regard to the risk of failure. And that's what I encourage everybody to do at a young age, whatever interests you. I don't care if it's, selling lamb's wool sweaters or, flying kites in the Arctic. It doesn't matter. If you like it, do it and try to find a way to turn it into a career. And a long story short, I ended up taking that very shortly. I got a job there. I took the head of healthcare position because they realized they really needed somebody like that. So here I am, 1 year of experience on Wall Street, and now I'm the head of healthcare at Oppenheimer Funds. And the year is like 2001. We're going into a big recession. And then once you go to Wall Street, so boom, I'm on Wall Street. Not only that, I'm not Mike King anymore on the television. By the way, I became friends with Mike King, and I always tell him this story, or I've told him many times. I'm sure he loves to hear it every time, but he was the inspiration. He's still on Wall Street, and he was the inspiration for me to get in. And once I got in, now it's trial by fire. Because the fail rate, and that's what I didn't know either. And this is part of being young and taking those risks. I didn't know that the fail rate was probably 80%. So even when you get there, you can't stay there because you just can't pick stocks like everyone else. Or you can't pick stocks better than everyone else. You have to be better than the average in order to be secure and stay in. There's a natural attrition in Wall Street where underachievers or underperformers are constantly shuttled out the back door. And it's probably 15, 20% of people, if not more, get shuffled out every year. I was really fortunate. I was able to survive by that trial by fire and excel. And I ended up running a carve out of a mutual fund there. And it was actually really big money at the time. I was probably accountable for $8 to $10 billion of investment capital. And at that time, that was an awful lot.
Yep.
And then I discovered along the way about hedge funds, where you run a book that's long and short. And that really intrigued me. The money was interesting about it, which it wasn't terribly different than what I was doing already. But what really intrigued me was the ability to see if I could go from go-kart racing to F1 racing, because it is F1 racing and it is extremely serious. It's extremely engaging. It's a nonstop job. There's never a minute that the lights are off. And I would be the first in the office and the last out frequently, out at 8, 9 o'clock at night. And I'd be in on Sundays to figure out how to beat everyone else. And I'm not really ever thinking of beating everyone else. It always ended up being that in the end game. But it's more of how can I make my fund perform the best? And how can I just blow the pants off of my performance? And that's what I was always interested in. And it worked out. I ended up going to a few hedge funds, and I spent most of my career at Citadel and Millennium, where I built teams and ran some of the, I guess at the time, it was the largest books in healthcare, around the largest books. And you have to realize that at that level, especially at that time, and this was like 05, 06, 07, 08. In healthcare, there were really only about 30 people running real hedge fund books at the time. Now there's probably, there's got to be 100 now, if not more. But of the really, really big books that are doing it, still there's only about 15 that are really that big. And so it really does, all of those people that have mediocre returns get shuffled out. And I really enjoyed that challenge of not being in the cold chair, the musical chairs where they pull the chair away and you're done. And I really enjoyed that challenge of not being that person every year. And I enjoyed finding brilliant people that find their way onto Wall Street, just astonishingly bright people, and being able to help them grow and watch them grow. And I really enjoyed that. I enjoyed that more than anything else in my career. It was working with the people. And I'm still very, very close friends with the vast majority of people that I've worked with. And we talk every day. And I help them with their book. We talk about all the things that are happening, data, scientific data that's coming out. Is this trial going to succeed? Is this trial going to fail? In med tech and biotech and everything else. And I kind of help them out on what's going on in the macro market because they have less experience than I do. The way to becoming good at understanding the economy is surviving recessions professionally. And I guess, I've been through two big ones, and I guess the next one will be my third. But they usually only come about every 8 to 10 years or so, if not more. And the last one was 08. So we're actually, what are we? Geez, we're 13, 14 years out. So I got to take a sip here for a second. You can ask another question, please.
Yep.
If you like.
So, initially when you started, you started off as someone focused on healthcare. So what was it like shifting your process from, sort of solely healthcare to focusing on the macro, as well as, other sectors as well. So what was that shift like in process?
That was a great question, a tremendous question, because you're going to get an answer that you don't expect. I didn't know anything about how the world worked. I thought I did, because I went to business school and they teach you everything. And then I learned in 2008 that everything I learned and everything I thought I knew about how the world worked is dead wrong, totally wrong, embarrassingly wrong. Mm-hmm. I started learning about how the world worked in December of 2008. After the first really big crash, I finished up the year about 4%. And I wish I knew what I know now, because it would have been a heck of a lot better. And I closed my book at the beginning of December. Stocks were moving 10% every day, and you couldn't tell which direction it would be. It would be based upon the headline. And I was just not equipped for that because I just didn't have experience to trade like that. It was terrifying. I was a fundamental guy. And I said, okay, how do I learn? Because there's no books that you can read, right? There's no book, how to survive a depression and a crashing market, like you don't. So I said, okay, well, what I want to know is what happened last time. And last time happened to be the 1930s. So I got a subscription to the New York Times archive, and I read the front page of the New York Times for every day between 1929 and about 1940. So 10 years of front pages. Yeah. That's what I read through the month of December. And holy crap, was that educational. And so everything that was even more interesting, then I could go, it tells you to go to page 5 and continue to read the rest of the article. And that's what I did. And so I did an awful lot of reading in December and January. And that was the beginning of my education in how the world works. And I learned, or I began to learn at that time, that the news isn't the news at all. It is a collaboration, potentially a conspiracy, a co-conspiracy of parties that are intertwined. The news media needs the politicians. They need the access. They need the story. They need the clicks. But they also need the advertising from the sponsors. And so you might think, for instance, why is our news media not hard on China? For instance, China's a big business partner. We don't really understand why. They must not be doing anything wrong. And there's many university professors who are very prolific and speak well about China all the time and never get called on it. And China runs a forced human organ, I want to say organ harvesting, organ theft. I suppose it's theft from humans, political prisoners and so forth. They have concentration camps and on and on. And why don't they report on that? That should be front page news every single day. Why is it not important? It's because of the advertising sponsors. The advertising sponsors cannot, they will lean on the news media to not print that. And that's what happens. And so it ends up being a compromised news media. And I learned that by reading 10 years of the New York Times, because there were some terrible things that happened during the 1930s. And I won't go into all of them. If you go through history, it was the Dust Bowl, all of the, so many thousands of banks failed, people were wiped out. But you could see there was a real conspiracy going underway at the level of the news media then. And that's what really opened up my eyes about, oh, this has been going on forever. And that's when I started to learn how the world works, how it really works. And I believe that how it really works is that there is an orchestrated effort to control the news message all the time. And frequently what we are seeing, a meeting between our president and Putin, a meeting between our president and Xi, or a G20 meeting, or even just recently, Biden sits down with Brainard. Ooh, might she be a Fed chair? Those actual meetings that happen, I don't even know if they actually happen. Meaning they might be going in and playing Parcheesi or Yahtzee or something like that. And the meetings already happened weeks ago, months ago. It's just, this is what the story is going to be right now. And what they say they're talking about, and this is the press release, might not be at all what they were discussing at all. This is just the kabuki theater that we're going to present, and then the news media will write about it. Whether it's true or not, they're going to write about it as if it's true. And so what I learned was to read between the lines. And earlier this week, and actually a couple weeks ago, I tweeted that Brainard is majorly in the running for the new Fed chairperson. I got a lot of pushback on that. But within an hour or two, the articles just by chance started coming out. And it was all the placement. And the reason why I thought Brainard was very likely to displace Powell, and we'll find out in the very near future, was because I had to think inside the head of this White House. And I don't mean inside of Biden's head. I'm saying inside of the general Democrat Party White House. Mm-hmm. They are very in tune with having political appointees in every single position that is that has their worldview, for every position, no matter what. And this is one of the outliers, the Fed. And so I thought that the news would heat up on this. And of course, we've seen a bunch of Fed officials kicked out. All of that also is sort of orchestrated events to create this situation where, oh, we need to clean up this Fed. So they're going to put a very nice female in there that no senator can say no to, because an election is coming up in November. And so they get their appointed official in. But why do they want that appointed official in? Because this official will very likely do their bidding. And their bidding will be to allow the economy to run hot during an inflationary period of time into the elections in November. And so what you had to do to think through all that was, well, what is this White House going to do in order to win? And what do they have to do? They have to dirty the Fed. They have to get this person out and their person in. How do they do it? Are they doing it? Obviously, they will do it. And then what is the purpose of that happening? And once you can start reading between the lines on that, and this goes all the way back to that New York Times 10-year period of time that I was reading about and how the world works. Once you understand the changes that are underway, well, how can you trade that? If Brainerd gets announced in December, we're likely going to have a material steepening of the yield curve. Now you have a trade. And that's how I became more of an economically, politically savvy investor, was taking that time to read and understand cause and effect. It's a lot like science. It's just a very different matrix that you're working in.
Yeah, because it's crazy because 365. So there's 365 days in a year, and if it's a 10-year period, that's 36. That's 3,650 front pages that you've read. So it is insane. And
well, I didn't. It was skim until you find something interesting. Skim until you find something interesting. But think about it. You can look through 10 days in about 30 minutes or less. So think about it. I'm going through 100 a day.
Yep.
So.
Yeah, and sticking to talking about the macroeconomy for a bit, I wanted to ask you, one thing that you've talked a lot about on Twitter has been what's going on in China, and I wanted to ask you to give your opinions on it, and just talk a little bit about, number one, what you're seeing going on, and number two, what kind of trades you have on that, to play what's going on.
Oh, okay. Well, there's two pieces to what's going on in China. One is the political, the other is the economic. And because they don't have a defined political system, meaning that if our president gets ejected or killed or anything terrible happens, there is a backup plan in writing. We have a constitution, we have amendments, we have a process. So vice president, and even if the entire White House gets eradicated, the Speaker of the House becomes the president. So we have a long list of safeguards. In China, there's none, right? It's more of a thug economy, thug politics. It's a strongman politics, and that's actually a term, strongman, that they use for more lawless countries, and this. Russia is like that, Libya, Myanmar. I mean, there's so many more, Venezuela, and on, and like China too. So that is the one aspect that is rather unpredictable. So if she turns up not with the living for any reason at any time, there will very, very likely be it will probably end up being some sort of civil war in the end, and it may be sooner rather than later. And that's my thought on it. I hope I'm wrong. I'm just saying that is probably the logical steps. But then economically, what's happening? China has their economy, their GDP is fake. It is, meaning the data is fake. It is well known to be fake. It is spouted about, preached, and modeled by Wall Street as if it's real. It's talked about by the news media as if it's real. China GDP up 6.6%. It is a number that should not even be reported because it is a man-made, falsified. It's a fake number. And then you have to go down the line on China and say, well, if that's a fake number, then is everything else a fake number? And the answer is, yeah, everything else is pretty much a fake number. Well, if that's the case, then when something bad happens, such as a collapse in the house of cards of housing or anything in China, a company, How can you ever predict that to happen when maybe those numbers are kind of fake, if not entirely fake? And the big problem that China as a government has in trying to manage their economy is that there is no second set of books. Meaning if the first set of books that they show everybody are fake, well, that's okay because we have the second set of books that are real. And so we really know what's going on. They don't have a second set of books. And so they don't actually know what's going on at most levels in such a very, very large economy. And that really sets them up for very bad things to happen, and very bad things that happen, such as what's happening now, and where you have a strong man who can basically set the law by fiat. You can just say this is the law now, and that's it.
Right.
And he and his economists are looking out forward 30 years, and they're saying, how the heck can China be a superpower if our population is going to drop by 30%? We'll have no workers, we have not enough young people. So what we need is for everyone to have more kids. We need to grow the population. So they got rid of the one-child policy. They now have a two-child policy. And they realized that the birth rate didn't change at all. So they moved it to a three-child policy. It hasn't moved at all. So you can have as many kids as you want now. It hasn't moved at all. In fact, the population is still cratering.
Right.
And so it looks at it, and you have to think like in the head of a dictator, was surrounded by yes men. What is the problem? What is the problem? This is my goal. I want the population to grow. How do we do that? And he starts looking, okay, all the financial instruments and financial companies, we need to make it available to the masses because people, the lower middle class, which is most of the country, doesn't have access to this stuff. So he basically steps into Ant Financial and others and says, this is how you're going to do credit now. I'm taking over your companies. And then he looks over at education. He says, you know what? We need more fair and level education available to everybody. So then people have more babies. So they basically essentially took over all of the education and said, this is what you're going to teach now. You're no longer for profit. That's a problem for business when the government steps in just on a Tuesday
Absolutely.
and says, yeah, that's the end. The same thing happened in Venezuela. And then lastly, and most importantly, the vehicle of Chinese savings, the real estate market. The real estate market is beyond bloated, inconceivably bloated, and everyone knows this because we've been talking about it for 20 years. And like all unbelievably great bubbles is that they go on for so much longer than you could ever believe, and all the shorts have been destroyed, carried out, and that's when it blows up. So she says, yeah, we need lower housing price. And I'll give you an idea of how much housing costs. Not every area, but many areas in China. If you do the rental rate equivalent, and you say, well, how much would this apartment that this family bought as an investment, how much would it rent out for? That calculation averages out to about a housing bubble that is 5 to 7x the level of what the United States had in 2008.
Wow.
And I mean 5 to 7x per capita. So now you get an idea. I think, and I'm drawing from memory, so you might be able to correct me, or maybe your listeners can, that in 2008, I believe that our construction as a percent of GDP, and remember, we actually have real GDP numbers, they don't, that the ratio was about 8% to GDP, and it's usually about 4 or 5 or so. And so it really had grown to a big piece of our GDP. And that's why it hurt so much when we had that collapse.
Yep.
In China, the construction, real estate related construction, is probably close to 30% of their GDP. Wow. And so now you get an idea. It actually is 5 to 7 times more of a problem.
Right.
And then you have to think about all the services and related furniture stores, carpets, on and on and on to fill all this stuff. So lowering the property values by kind of a fiat mandate, and you got to love China though, because when the going gets tough, and I'll give you a tiny backstory in that what happened, for instance, Evergrande, and I brought this up on a program earlier in the year. all of these companies kind of saw it coming, these construction companies, the builders, I believe, because over the years, recent years, all of them have completely hollowed out their working capital and dividended out the proceeds to the investors, which happen to be largely the executives who owned a big slug of the company. And they hollowed it out by just saying, hey, everything's good. We have fake numbers here. And so things are so good that we're going to dividend out, have a big one-time dividend or whatever, right out to management and other shareholders. But what really was happening was that they started pre-selling entire cities and offering financial investment products through the banks in order to make the working capital to build that city. So they didn't actually have the working capital to build anything anymore. They had to raise the money to get the working capital to build it. And they have a different mechanism here or in China rather, versus here. Here, you don't pay until you are delivered your home. You might pay a deposit, right? But you don't actually pay for it until you receive the home. There, you pay up front, and that's how they could do it. And then they deliver it to you whenever. And so that's how China's gotten themselves into real trouble, because I don't think that the Communist Party understood how hollowed out these businesses were, and that they've already taken all the cash out of the business, given it out to the executives, and now they don't have enough cash to build what they said they were going to build. And you're saying that you got to take the prices down. So it's an instant collapse. And what they're really trying to do right now, they're not trying to put the genie back into the bottle yet. They're just trying to say, okay, don't just put your foot out of the bottle and stay there. Just stay like that. And that's what they're trying to do. It's very unlikely to be successful. So I think we're going to very likely have a very large problem over there. Now, the good news for China, though, and the rest of the world, so bad news for China, whatever, but good news for the rest of the world is that there's not a lot of foreign investment that's jammed into Chinese housing. It's been captive. And part of the reason why it's been captive, the entire reason, is because individuals in China pretty much are not allowed to invest their money outside of China. So it all has to be in China. And so you had two choices, the stock market or housing. And so everybody invested in housing. And that's why, you have so many families that own 4 or 5 apartments, and they're very expensive, by the way. I mean, the price, like I mentioned, is 5 to 7 times what it should be. And they're paying enormous mortgages, by the way, meaning if they rented it out, it would only cover 20% of their mortgage if they rented it out. So because the agreement was with the government is that housing prices will always go up. So therefore, invest in housing. Right. And now that relationship is being broken down, because now it doesn't serve the government, because they've priced out of housing every single family in the country. So guess what? There's no babies. And so now we have a problem. So that's what's going on in China. It's a very, very difficult problem to solve without popping the bubble and the house of cards blowing up. And right. Just to mention again, what exacerbates it is that they don't know how bad the actual books are in the companies, because these companies are not actually audited. That's it. So it's probably fake numbers with much more debts. And so when it blows up fast. And that is one of the big fears that I have. And that will affect a lot of things. It'll affect commodity markets. It'll affect demand. Because the Chinese are consumers, big consumers, Louis Vuitton, Nike, and many other things. They are a pretty big consumer, and they can get rattled badly because most of their savings is in housing. We haven't seen it happen yet, but it's probably happening right now. We just haven't seen it in the companies yet.
Yeah, I know, it is insane, because the way you describe the problem, once, as you mentioned, the house of cards gives in, it's sort of all over. But how are you actually thinking about the timeline of this playing out? Because in a way, there's it's sort of what everyone's thinking is that you can't really have a crisis in China unless the CCP allows it. So in a way, the
yes.
CCP can actually just step in and forever just prolong whatever's going on right now and then postpone the crisis. So how are you actually thinking about the timeline of this playing out?
So I'm actually a little bit more concerned about the thug war that's going on, because we've seen a lot of high level people disappear for long periods of time, and that's basically being re-educated by the CCP, and that's a real that's a war going on to wipe out the elites. And we saw this we've seen this happen with many socialist or communist countries, where they are doing the final last power grab and they want to nationalize everything, but they're not nationalizing everything because they think it's a good idea. They're doing it out of fear. They're doing it because they need to kill all the elite before they kill them. And that's what I'm actually really worried about, is that there is a disruption in the CCP power, who's in charge. And it will be a very messy disruption. Whenever you see the financial situations, hit the skids, a lot of people, the elite, are going to lose all of their wealth or end up disappearing. And that will force them to do extreme things, like get rid of the guy that's causing all this, which is Xi.
Yeah.
And so I think that there's a greatly elevated probability that a huge problem comes up, where Xi is disappeared, or dies in a tragic gardening or kitchen accident, where that's it.
Accident.
Yeah, a mystery best left unsolved. And that will be actually very, very, very disruptive. But at this point in time, I think much more probable than any other time. And this would actually be the kind of playbook that happens in many, many countries in this situation, where the executive branch ends up getting ejected in a very messy fashion. The alternative is that they are able to consolidate power even more, drastically more, where all the other elite are wiped out. A little bit more like North Korea, where it's truly, absolutely lawless, and the country, one man owns everything, and everyone else is a servant to that person. And that's a very, very dangerous setup also, because then you have a dictator without compromise who has only surrounded by yes people, and that's a very dangerous situation for the world. So I think if she were gone, it would end up being much, much, much better for the Chinese people over time. But it would be devastating very quickly to the world economy. That's what I'm actually really worried about. The rest of the China house of cards and things blowing up, it'll affect things, but not terribly badly. On the order of a couple percent of global GDP, and I think that's been cited a couple times. And I really can't disagree with it, because a lot of the problems are internal. Meaning the investors are internal, the debts are internal, they're all in RMB, and it would really just fall on the Chinese people to suffer through it, but it really wouldn't affect the rest of the world too much.
Yeah. And I wanted to move on and talk a little bit about, I guess, stock picking as opposed to macro. And the field that you've sort of specialized in has been healthcare. So what's your process like for actually picking good healthcare stocks? Because in a way, the way healthcare stocks work in a way slightly different from normal stock picking, because in a way normal stock picking is looking for high gross margins, low PE, stuff like that. But the healthcare opportunities seem to be a lot more idiosyncratic relative to, I guess, general stock, I guess, the non-healthcare stock picking. So how do you actually think about finding both investments on the long side as well as good shorts?
Okay, so for larger cap companies, I think a lot about what investors have to do And I don't mean investors like you and me. I mean investors like Fidelity and, T. Rowe Price and Cap Re. What do they have to do? Because they have to make choices. Am I overweight this? Am I underweight that? And so I spend a lot of time trying to put I call it a vanilla investor. These non-hedge fund guys are vanilla guys. So I take the vanilla guy investor and I put their helmet on and I try to think like them. And I spend a lot of time doing it as to what they have to do, how they have to react to news that is coming. Especially in healthcare, we can figure out often, me and my team of people that I've worked with for the past 20 years, we can do pretty well in figuring out, in many instances, what is going to happen in a company. Specifically, is this drug going to be successful? Is it going to be a failure? But the real question is, what do the vanilla investors think? What's their consensus, which can be different than ours? And what do they have to do? Do they have to buy it? But if they're buying something, they're selling something else. What are they selling? What are they buying? And basically for large caps, you are essentially trying to front run their mind in that collectively, how are they going to think and how are they going to react? And so you couple that with new product innovations. Can we identify something that is a new product story that the world doesn't understand yet, that ideally has pricing power in a growing market? And so if you can put together the vanilla mindset that doesn't understand something with a new product story that has pricing power in a growing market, well, then you really have something on the buy, especially if it's meaningful in the benchmark of names. And when I say a benchmark, for instance, the ETF that I manage, and we're not saying what it is, because we're not allowed to say on this call. It is benchmarked to the MSCI US healthcare stocks. And a good proxy for that, Fidelity has one. I'm looking at my Bloomberg right now. Okay. So it is Fidelity Healthcare Index ETF. It's MSCI Healthcare Index ETF. And you can just look on Bloomberg if you have it and see all the top holdings. You can actually look online and find out what their top holdings are. And so I can see what it is. And this is designed to mirror that ETF. And so when all the vanilla investors, all they're thinking about, the number 1, 2, 3, 4, 5 holdings in it are Johnson & Johnson, United Health, Pfizer, Thermo Fisher, and Abbott Laboratories. And that represents 7, 4.5, 4, and 3.7% of the index. So they are terribly worried about getting those 5 names right. Because if you get those 5 names right, you can perform in line or outperform the index, ideally outperform.
Absolutely. Yeah.
And so that's what I'm thinking about, is what are the choices that they can make? And sometimes some instances are very, very easy for me to see. Go down the line and you look at Bristol Myers at 2% weighting. Bristol Myers models out like an absolute nightmare over the next 7 years. They are going to lose 70 to 80% of their revenue over the next 7 years due to patent cliffs in a way that I've never seen before. I've never seen a company model out that bad. And it's 2% of the benchmark. And so if I was going to set up my fund, I'd say, well, they're going to figure that out starting this year, that the numbers are way too high. So I'm going to have a 0 weighting. And that's a choice. And that's largely how I do it. And also you can do that for shorting stocks. You're going to say, you look at this benchmark of names and you say, well, which ones do they have to sell? Which ones are going to blow up on their execution? And all the benchmarkers already own it. So I'll give you an example of that. Moderna, a very popular stock and company now, And that was a vaccine maker. It got up to $130 billion market cap. In fact, for a little while, it was bigger than Merck and Company. And that is a bet that vaccinations for COVID are going to happen forever, every year. And because they just did $20 billion in rev, and if you're going to have a $130 billion company, you have to make the assumption that you're going to have $20 billion in these revs of vaccines every year forever, if not growing. And that's what's actually built into the stock. Well, about 2 months ago, Moderna was 220 basis points of that benchmark. And it's probably ran up because it was such a big idea, and the benchmarkers never owned enough that they chased it up out of fear of missing it, because while it's going up, they're underperforming. They don't even know what this is. Remember, most of the healthcare people that cover it for big funds, they don't know science, or at least it used to be like that. Right now, it's still about half and half. And so I came in and looked at this and I said, I should have a zero weighting on Moderna, because they're going to have to tell us that there's no way they can make the street numbers for next year. I just wasn't sure exactly when they'd tell us. But they did tell us about a month ago. They put out their numbers and they said, there's no way we can make numbers next year because we're not going to have vaccines every year. And the stock dropped, and it went from 220 basis point weighting to 130. So if you had a zero weighting in Moderna, meaning it got cut in half, if you had a zero weighting in Moderna and running a benchmark sort of basis fund, you could have picked up 90 basis points of performance. By the way, running a mutual fund or an ETF, your goal is to outperform the benchmark. And a good outperformance is about 3 to 4%. That's a very good outperformance. It's about 3 to 4% a year. Net of fees. That's top decile, by the way. Most of them, if they outperform, it's only 70 basis points, 100 basis points. But right there, if you had a zero weighting in Moderna, you could have picked up 90 basis points in 1 month. So, but once you start thinking like that, well, what do you mean I'm a zero weighting in Moderna? Why am I not short Moderna? There's money to be made here, and that's going into hedge funds, where ideally you can hedge yourself against market moves, but also pick up alpha, meaning money. And alpha doesn't always mean money, but it does mean that you can pick up a return versus the benchmark by being short that stock, and that's what you can do. And that intrigued me a lot, and that's a big reason why I ended up in hedge funds, because I really like that challenge of doing that. And that's a lot about how I think, not to get into the nitty gritty on science and so forth, but that is how I think about stocks. I think very much of them is not companies at all. They are vectors. They have weight and direction. They are a vector, just like in physics. They're just a thing on the chart. They have weight, they have volume, they have direction. And the people that are generally buying and selling stocks, for the most part, really don't actually know a whole lot about them. So even to them, it's just a vector, because they don't have the time to know all these things. Even most vanilla managers that are managing, an overall, not healthcare, but all over S&P account, how can they be an expert on what Cisco is going to put out tonight? They whiffed, by the way. And what Johnson & Johnson is going to do on their analyst day next month. They have no idea. How could they possibly know? So really, it goes back to the benchmark, and it's really about what they're afraid of. And so that's what I think about it. And fear goes both ways. For vanillas, it's not the fear of being in a stock that goes down. That's not the problem. The real problem is being underweight in a stock that doubles. That's much worse, because that will get them thrown out of the business over time.
And when you talk about shorts, I'm curious. So how do you actually manage the risk? So when you were actively running a hedge fund, how do you actually manage the risk of your the short end?
That is a great question. And let's see, in about 20, it was probably about 2013, I started, believe it or not, I'd start doing something called a risk reversal, which is an options trade, and I'll tell you about it, around shorts. And it was only shorts, because the only thing that really bothers you, especially in biotech, in the drug space, is getting a takeout in your short book, meaning someone acquires this terrible company that is a freaking zero, but they think it's great and they buy it at 100% premium. And that happens in biotech all the time. And I mean all the time, in that we've seen many, 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 many times where Pfizer or others, any pharma company gets it in their head that this is the next biggest, baddest, best thing, and they got to have it. And then they buy the company, and then secretly on a Friday night at 6 p.m., they're writing down 50% of the value of that acquisition 1 year later, and it's just 6 p.m. on a Friday every single time. But what happens in the meantime is the guys who are short that stock, you might have been right. You wrote it down. See, it's a total zero. But it doesn't matter, because you just took that incredible hit in your book. So frequently what I do around companies that I thought could get taken out, and it's actually saved my bacon many, 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 many times. I'll give you, I was wondering if I can get a chart up on Cubist, because that was a really good one. I don't know if it got taken out by Merck. I want to say it was 15. I don't know if it'll come up now. I wish I could get the historic charts. Anyway,
No problem.
Anyway, so just imagine the stock that I'm short is at $100 a share, right? And I know that some crazy buyer could come in and take it out, so I don't want to get my face ripped off. And so what I'll do is I'll buy 1 month out. I'll buy a call for 20% out of the money. Now, there might be no catalyst, no catalyst. And so nobody's expecting anything. The vol isn't juiced. So it's actually very reasonable. And I'll sell a put 20% out of the money. So I'll buy a call at 120. I'll sell a put at 80. Okay. So if the company gets taken out at 180%, $180, I'll get capped at 20% loss, 20% up, and I'm capped. So I can live with that. I can survive that. But if the stock goes down, I'll also get capped, because the puts that I sold will kick in when it's 20% lower at $80. And so it limits my downside or my profit in my short. So my short goes down there and I get boxed at 80. So I'm closed out at 80. So that I have to live with that. But often, especially at funds like Citadel Millennium, we have to make investment choices that we don't always like in order to balance the book. So sometimes we're short names, not because we think it's a really, really bad idea, meaning the stock's going to go down. We're just trying to hedge a stock that looks like this with another stock that looks like that. So their factors are very well aligned, and I may not really want to be short this one. And so what I'll end up doing is I'll put a risk reversal around it. And those are some of the troubles with running a hedge fund, is that not everything is a perfect fit. And we just live with it, right? It's never going to be a perfect fit. Nothing is a perfect fit. So we just do the best that we can. And if you're smart about it, it can work out well. But that is one of the ways that I hedged. And I actually got in an awful lot of trouble for it, because it saved my bacon quite a few times. But if you may not know that when somebody sells me that market, put on that risk reversal around $100 stock, the market maker likes to bag a little bit of extra cash, so they don't fully hedge themselves. They look at it and say, well, what's the probability this is really going to go up 20% a month? And they go to their risk thing, the risk guy, he's inside the computer, and he says, well, historically it's only about a 14% chance. And he's like, okay, so we'll only hedge 14% of it or something, right? Because he wants to pocket all that, you know, and then it does get taken out. And I'll get the call. How did you know? And I'll get the lawyers. How did you know you were buying calls and da 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 da? I was like, no. I'm trying to hedge my position. I had no idea this was going to happen. Well, it got to the point because my book was so big that I'd have difficulty getting options markets made for me specifically. And I think it's a lot better now because there weren't many books that size back in 2013, 2014. Now there are a lot of books really big sized. And so it's probably much more liquid now and a little bit more sophisticated. But that's the thing about options is that when you go online and your Robinhood account and you're buying options, it is an absolute ripoff factory. The bid ask is crazy wide. They're just pocketing on you every which way. So it's very difficult to get it done efficiently. Yep. So that's the risk to putting those protective trades on. But I did it quite a bit. It saved me. It had to have saved me at least $50 million over the.
Wow, that's awesome.
Yeah, over a few year period.
The other thing that I wanted to ask you, what are the opportunities that you see in biotech, pharma, healthcare today, for investors to take note of?
Well, there's an opportunity to view all of the dead bodies that are floating down the East River. We are in a termination cycle. There are a lot of books, hedge fund books in healthcare that are getting blown out. And that I think that's probably news because it hasn't been written yet, but I am aware of a half dozen books that are out at least, and probably a half dozen more at least that are going to be out. So, and that's a big number. In fact, I haven't seen this much turmoil since 2008. And I've never seen this much turmoil outside of a recession. And that's what's going on in the space right now. There's going to be a lot of job openings in Jan and Feb because I moved out. Did I actually answer your question?
I don't think. Yeah. Well, I was more like referring to any specific stocks or stuff like that you're looking at.
Oh, okay. Yeah. Well, that's the specifics of the dead bodies. I am a bit reticent to talk about. Okay. Well, no, I am a bit reticent to talk about specific stocks, only because I am, especially in healthcare, because I am actively managing a fund that's very important to me, and I will say this. Is that the pharmaceutical names right now are modeling out. When you model them out, you look out about 5, 6, 7 years, and you really have to because they have big patent cliffs. All these companies, so you have to look out for those coming. They model out very, very badly. The worst I've seen in a decade, if not longer. And I think that the med tech names and related are going to materially outperform the large cap pharmaceutical names, especially if yields are going to go up, because then dividend yielding names like pharma will become less attractive. So I am not very bullish on the large cap pharma names overall. So, and I think the book that I'm involved in, the ETF, reflects that.
And to wrap up the podcast, I wanted to ask you, for any young investors or younger people trying to get into the investing space, what's sort of the best advice you would give to them from a career standpoint?
Yes. Okay. The most important thing to know when you play poker or trading, because when it's a lot like playing poker, being an active money manager or let's say a new manager with a Robinhood account. It's a lot like poker. And the most important thing to know in poker is who is the idiot at the table. And you must know and be acutely aware that as the new person there starting out, you are the inexperienced sucker at the table. Now, you won't be so much if you know it. So it's very, very important to take it into consideration is that if I do well, was I good or was I lucky?
Yep.
And that's and the hard part about it is that you will not know if you were good or lucky for a while, because you can be lucky for a pretty long period of time. And then you realize that it's luck when you lose all of your money in over 8 days or whatever. And so I think that we have a retail investor world right now that has been floating on a wave of liquidity that has lasted for a decade, from central banks constantly coming in to hike asset prices up. And so there is an entire generation of investors that don't even know what a recession even looks like. They have no idea. And I have to be aware of that because to me, 2008, 2009, that was yesterday. But if I look at the calendar, my goodness, that was 12, 13 years ago. So there's a whole generation of investors that haven't seen it yet. And think of it like this. As the assets have grown, meaning the S&P, the NASDAQ, whatever, all these assets have grown. All the hedge funds have grown proportionately. And the leverage within has grown even more so as interest rates have gone down. So the actual amount of dollars that are running around is over 100% more than it was 7 years ago, which means you need 100% more new people to run that money. So the number of people has doubled. Well, if the number of people have doubled in the past 7 years running this money or more, that means that almost all of them have sub 7 years of experience. So basically, half the people running money right now have never seen, in hedge funds, have never seen a recession. So you have a real setup for a problem, if a problem does arise. And that's very important for young people to understand, have the maturity for it. Understanding where you are in the cycle. And we are... I wish I was smart enough to tell you now where we are in the cycle, because in the event that energy costs stick into next year and some input costs, in the event that the government is going to spend an awful lot of money to try to keep everyone happy, we're probably going to run into a very abrupt problem in the back half of next year. However, if these input pressures abate, peaking in 1Q, which I think there's a high probability that could happen, just because productivity and the capacity for putting more output has never failed before. You know, we never had that happen where, oh, I'm sorry, we can't make these widgets. Keep your money, we won't take it. That never happens. You know, give me your money, yes. And that's what always happens, so they can deliver the widgets. Well, we'll have an odd situation next year where the companies have lifted prices, but now the input costs are going down. So that means that revenue versus expenses go like that, and margins, oh, I should get in front of the goddamn camera, and margins explode. Sorry. And margins explode. And so there is an instance of that. So there's going to be a lot of moving parts next year. And I would share this, though, that virtually everybody I know has not traded an inflationary environment before, and nor do they know anyone who has. So everyone's very, very naked out there and trying to trade this right. So I think it's going to be a very, very turbulent 22. And I think what is going to work in 22 is it's going to be a great stock pickers market, because I think there's going to be an incredible share of winners and losers. And they're going to be dramatic winners, dramatic losers. And I think for hedge funds next year could be extremely good, even if the markets aren't that good.
We're getting me excited by calling it a stock pickers market. So
Yeah. Oh, it's going to be a big stock pickers market. Big stock pickers market.
it's awesome.
I'm excited about it. I'm excited about it.
Same.
Because this year and last year were extreme stock pickers markets, but in a way that nobody ever understood or could have thought about, because of COVID, the crash, the return, the mini crash, the return. It was very, very difficult for analysts to get it right because they're not equipped to think about how a virus will affect the entire world. And how long will it last, and when will it stop, and what will the government do, and what will be that impact? That has nothing to do with analyzing companies. And that's why so many hedge funds have not done well, because it was not about companies. It was about vectors on a sheet. That's it. And that's a different way to look at it. So
Yep.
I can't wait. Next time we get together, you got to show me the names that you own, because I'm just so curious what people think are good ideas. And I don't mean it because they're not good ideas. I mean it because I always learn something when I talk to newer people that are into the investing world. I learn so much. And that's part of being successful at this. You have to approach it every day as if you're an amateur.
Yep.
I'm an amateur. I am confirmed amateur almost every morning at 9:30 a.m. because something happens that I never expected every single day, and I'll never get it right. So I'm stuck. I'm an amateur. So us amateurs have to get together and compare notes.
Mike, with that, thank you so much for being on the podcast. It was an absolute delight to have you. And
thank you so much.
Thank you, and take care.
Have a wonderful day.